Okay, steps 4 and 5, we're going to calculate the before tax equity reversion or the sale of the property, and also the capital gains tax to ultimately, at the end of step 5, calculate what's called the after tax equity reversion. So that's the goal here. What we've done in steps 1, 2, and 3 is calculate the cash flow from the property. Or in other words, what's left in the investor's pocket after everything, after vacancy and credit loss, after operating expenses are paid, after the debt service is paid, after taxes on the income is paid. What's left over? What's the bottom line for the investor? For cash flow, it's after-tax cash flow. But investors are also interested in potential appreciation. Okay, the property value going up over time in return from the property appreciation. So steps 4 and 5, we're going to get to the after-tax equity reversion, or what's in the investor's pocket from the sale of the property. Well, step 4, we're going to start out with the before-tax equity reversion. And again, remember, right now we're at the end of the third year. It's a third-year holding period, and the assumption is at the end of the third year, we're going to sell the property. And the assumption for the sale of the property was it's going to increase 9% lump sum over the holding period, over the 3-year holding period. And just to prove it, remember the property appreciation over the holding period was 9% lump sum. So in other words, we're going to sell the property for 9% more than we purchased the property. So if you take 135,000 times 1.09, that gives you 147,150. But that's not money in the investor's pocket. The assumption was that we're going to pay a 6% brokerage commission when we sell the property. Remember, the broker's commission typically comes out of the sale of the property. So 6% of 147,150, that's 8,829. Subtract that. That gives us what's called the net proceeds from sale, and that's 138,321. But that's not money in the investor's pocket, because remember, the investor purchased the property by borrowing money. Okay, through borrowing money from a lender. And when they sell the property, remember the due on sale clause says that you got to pay off the mortgage balance when you sell the property. So at closing, the investor doesn't get to keep 138,321 because they have to pay off the mortgage balance. Now you can calculate the mortgage balance with your calculator. You should know how to do that by now, but there's actually a little bit of a shortcut in this problem. Remember, the original mortgage balance was 108,000. The investor borrowed 108,000 to purchase the property for 135,000. The amortization each year was given to us. Okay, this is how much the loan was paid off each year: 600, 663, 733. So if you add these up and subtract it from the original mortgage balance of 108,000, that should give you the mortgage balance at the end of the third year. So what we've done here is take 108,000, subtract out 600 minus 663 minus 730, I think it was, and that should give you $106,004. That's the mortgage balance at the end of the third year. Subtract that from the net proceeds from sale, and that gives us the before tax equity reversion, 32,317. But that's still not money in the investor's pocket. The investor has to pay possibly capital gains tax. So step 5, it's a little complicated, a little lengthy. Don't blame me. This is what the IRS wants, and there is a shortcut to doing this. And it's, in this example, and this is how it's demonstrated in the IRS examples. We're going to break up the property into building value and land value, and calculate the capital gains on the building separate from the land. And then at the end, we're going to put it back together to calculate the overall capital gain. And that's what we're going to multiply times our capital gains tax rate. But we're going to go through the process, and here it is. The first thing we do is we bring down the net proceeds from sale from above. So the net proceeds from sale is just from step 4, 138,321. And we're going to break that up into building value and land value. And we're going to subtract out the value of the land. And remember, we're at the end of year 3 now. The land value, we're going to assume, is still 15% of the overall value. Remember these? The 15% and the 85%? Well, we're going to assume that this relationship doesn't change over the 3-year holding period. That land is still about 15% of the overall property value, and the building value is about 85% of the overall property value. Now, this potentially could change, but for simplifying purposes, let's assume that it holds steady at 15% and 85%. So, if you take 15% of the future sales price of 147,150, that's the value of the land at the end of the third year. So subtract that from the net proceeds from sale. That gives you the value of the building at the end of the third year. So this chicken scratch actually says building value, but the building value is 116,248. Now the next step is to calculate the original basis. The original basis was 114,750, and that was 85% of the original acquisition price of 135,000. Remember, we took 114,750 divided by 27.5 to calculate the depreciation for each year. Well, that's our original basis, 114,750. If we have any capital improvements that we've made to the property over the 3 years, we can add those in now. There's nothing in the problem referring to capital improvements, and we're not gonna worry about that typically. That's a complicating factor that, if it does happen, you should know how to take care of it, but it's not one of our complicating factors for this problem. So the original basis still holds at 114,750, and here's where the depreciation comes back to haunt us. Each year we've been taking straight line depreciation of 4,172.73, and that's been helping to shelter some of our income, so we actually ended up with negative taxable income for all 3 years in this example. But every time we take a depreciation deduction, it reduces our original basis, or what we have into the property, what we originally paid for the building. So what we need to do next, and this hurts us, this is going to result in us paying more capital gain, but investors are still like depreciation because, number one, the capital gains tax rate is lower than the income tax rate. So what would you rather pay tax on, income or capital gain? Well, if your income tax rate is 28% and your capital gains tax rate is 20%, if you're rational, you'd rather pay a capital gain tax than an income tax, all things being equal. The other reason why investors still like depreciation is because of the time value of money, and we should know how important that is. When would you prefer a $4,172 deduction? In year 1 or at the end of year 3? Well, again, a rational investor would prefer a deduction today rather than in the future. In the future, the deduction is worth less, and you have to postpone, consuming that deduction into the future. So investors like deductions now rather than later, and they like paying lower tax rates. So they typically prefer the lower capital gains tax rate to paying higher income tax rates. So depreciation is still a great thing, but right now it's going to hurt us a little bit because it's going to reduce our original basis by the amount of depreciation we've taken over the 3 years, which is just adding up the 4,172 times 3. Okay, just adding up the depreciation we've taken each year, sum it up. We're taking 1,472 times 3. And so this is our total or accumulated depreciation, 12,518. And that reduces our original basis to what's now called the adjusted basis, to 102,231. And we take the value of the building at the time of sale minus the adjusted basis, and that gives us our capital gain on the improvements. Notice if we didn't have to subtract out accumulated or total depreciation, the difference between 116 and 114, that's only about $2,000. But our capital gains on the improvements is $14,016, and a lot of that's attributed to the depreciation that we've taken, the $12,518 in depreciation. So we're going to have to pay capital gains tax on about $14,016 of the increase in the building value, or a combination of the increase of the building value and more so the decrease in the original basis due to our depreciation deduction. All right, we'll hold on to that number for a minute because the next thing we're going to do is calculate the capital gain on the land. The value of the land at the time of sale, we calculated above at $22,072, so just bring that down, less the original land value. And the original land value was 15% of the $135,000 acquisition price, or $20,250. So the capital gain on the land is much easier because we don't have depreciation. Land does not depreciate, right? But the capital gain on the land is simply $1,822.50. So bring that over here and then add the two capital gains together, and our total capital gain is $15,839. And that's what we have to pay capital gains tax on. And our capital gains tax rate was 20%. So 20% of $15,839, that's $3,167.84. So at the time of sale, we have to write a check to the government in the form of capital gains tax, or when we pay our taxes, for $3,167. That's our capital gains tax at the investor's capital gains tax rate. All right, well, steps 4 and 5 we're through. We're going to go on to steps 6 and 7 and wrap the investment problem up. But please proceed to the next clip. Bye now.